Hello and welcome to my screencast where we are going to look at petty cash. Firstly, let's look at what petty cash is using a simple definition. A petty cash fund is generally a small amount of cash kept on hand to pay for minor cash needs. The size of the petty cash fund varies across businesses, but it generally involves three main activities. These activities are, firstly, establishing the fund, secondly, making payments from the fund, and thirdly, replenishing the fund. So let's look at an example. Suppose Sarah owns a clothing store and on March 1st decides to create a $400 petty cash fund for her business. In order to establish the petty cash fund, a journal entry must be made. Notice, we debit petty cash and credit the cash account. The entry increases petty cash and decreases cash. However, there is no change in total assets as Sarah's business has dedicated $400 to be used in the petty cash fund. Once the fund has been established, the cash can be used to pay for minor expenditures. This can be done in two ways. Cash can be taken from the fund to make payments, or employees can seek reimbursement from the fund when they make payments personally. It is very important that all receipts are collected. Note that no journal entries are made at this stage. They are only recorded when the fund is replenished. The third step is to replenish the fund. This involves counting the remaining cash in the fund, and Sarah's company then cashes a check that will bring the fund back to its original balance. The receipts of the fund are used as documentation for the expenses. Suppose that during March, Sarah's business made the following disbursements: $150 on supplies, $90 on fuel, $60 on postage, and $45 on miscellaneous expenses. A journal entry is then created. The entry increases the four expense accounts related to the expenditures and decreases the cash account for the amount of the check. This entry reduces both assets and equity.
Created using Powtoon.